Can you do a 1031 tax exchange to buy land and build a home? If you answered no, this video is for you. Welcome back to our channel. Today, we're diving into a topic that often confuses many real estate investors: the misconceptions surrounding 1031 tax exchange laws. If you're looking to defer capital gains taxes on your property investments, understanding the ins and outs of a 1031 exchange is crucial. In simple terms, a 1031 exchange allows real estate investors to sell a property and reinvest the proceeds into a like-kind property, all while deferring capital gains taxes. This powerful tax strategy has been a game-changer for many investors, enabling them to grow their portfolios without being burdened by hefty tax bills. Despite its benefits, there are several misconceptions surrounding 1031 exchanges that often lead investors astray. One common myth is that 1031 exchanges are only for large-scale investors, when in reality they can be utilized by investors of all sizes. Another misconception is that the process is too complex and time-consuming, deterring many from taking advantage of this tax-saving strategy. By shedding light on these misconceptions, we aim to empower you, our viewers, to make informed decisions when it comes to your real estate investments. Understanding the truth behind these myths can help you navigate the 1031 exchange process with confidence and maximize the benefits it offers. Stay tuned as we debunk more myths and provide valuable insights on navigating the world of real estate investing. Misconception 1: immediate tax deferral. Many investors mistakenly believe that 1031 exchanges provide immediate tax deferral, allowing them to avoid paying taxes altogether. However, the reality is a bit more nuanced than that. In a 1031 exchange, the tax on capital gains is deferred, not eliminated. To qualify for tax deferral, investors must adhere to strict guidelines set forth by the IRS. This includes identifying a replacement property within 45 days of selling the relinquished property and completing the exchange within 180 days. It's important to understand that tax deferral does not mean tax elimination. While a 1031 exchange allows investors to defer paying capital gains taxes when they sell a property, those taxes will eventually be due when the replacement property is sold without another exchange. However, savvy investors can continue to defer taxes by engaging in successive 1031 exchanges. Let's consider an example. Sarah sells a rental property for a profit of $200,000. Instead of pocketing the proceeds and paying capital gains taxes, she decides to reinvest the funds in a like-kind property through a 1031 exchange. By doing so, Sarah defers paying taxes on the $200,000 profit, allowing her to leverage that money for further investments. Misconception 2: limited property types. One common misconception surrounding 1031 exchanges is the belief that only certain property types qualify for this tax-saving strategy. In reality, the guidelines for eligible properties are more flexible than many investors realize. The IRS allows for a wide range of property types to qualify for a 1031 exchange, including but not limited to residential rental properties, commercial real estate, vacant land, and even certain types of personal property used in a business or investment capacity. While the IRS is fairly lenient in terms of eligible property types, there are some restrictions to be aware of. For example, primary residences, inventory held for sale, and property held for personal use do not qualify for a 1031 exchange. Additionally, properties located outside the United States are not eligible for this tax deferral strategy. One of the key benefits of a 1031 exchange is the flexibility it offers in terms of property types. Investors have the freedom to exchange a wide variety of real estate assets, allowing them to diversify their portfolios and optimize their tax savings. Whether you're looking to swap a rental property for a commercial building or trade vacant land for a multifamily complex, a 1031 exchange can be a powerful tool for growing your real estate investments. Misconception 3: one-to-one property exchange. A common misconception about 1031 exchanges is the belief that investors are limited to a one-to-one property swap. In reality, the concept of like-kind exchange allows for more flexibility and creativity in structuring exchange transactions. The key principle of a 1031 exchange is the requirement that the properties involved be of like kind, meaning they are similar in nature or character. This does not mean that the properties must be identical or have the same value, but rather that they are both held for investment or business purposes. Contrary to the one-to-one misconception, investors can exchange one property for multiple properties or vice versa in a 1031 exchange. This opens up a world of possibilities for diversifying and expanding real estate portfolios while still enjoying the tax benefits of a like-kind exchange. To debunk the one-to-one myth, let's consider a scenario where an investor sells a commercial property and acquires two residential rental properties in exchange. This transaction would still qualify as a 1031 exchange as long as all properties meet the like-kind requirement. Another example could involve exchanging a portfolio of rental properties for a single, larger commercial property. These complex exchange scenarios showcase the versatility and potential of 1031 exchanges beyond the constraints of a one-to-one swap. Misconception 4. Personal residence qualification. There is a common misconception that personal residences can qualify for 1031 exchanges, allowing homeowners to defer capital gains taxes when selling their primary homes. However, the IRS regulations clearly differentiate between investment properties and personal residences in the context of 1031 exchanges. In a 1031 exchange, only properties held for investment or business purposes are eligible for tax deferral. Personal residences, also known as primary homes, do not qualify for like-kind exchanges under IRS regulations. This means that when selling your primary residence, you cannot use a 1031 exchange to defer capital gains taxes. The IRS specifically excludes personal residences from 1031 exchange eligibility, as these properties are considered to be held for personal use rather than for investment or business purposes. Homeowners looking to sell their primary residences may be eligible for other tax benefits, such as the capital gains exclusion for the sale of a primary residence. For homeowners looking to minimize taxes on the sale of their primary residences, alternative tax strategies such as the capital gains exclusion under Section 121 of the IRS Code may be more appropriate. This provision allows individuals to exclude up to $250,000, $500,000 for married couples of capital gains from the sale of their primary residence if certain criteria are met. While 1031 exchanges may not apply to personal residences, there are other tax-saving opportunities available for homeowners looking to maximize their profits when selling their homes. In this video, we've debunked some of the common misconceptions surrounding 1031 tax exchange laws, shedding light on the nuances of this powerful tax-saving strategy. Let's recap the key points discussed and clarify any misunderstandings. We address misconceptions such as the belief in immediate tax deferral, limited property types for exchanges, the requirement for a one-to-one property swap, and the eligibility of personal residences for 1031 exchanges. By providing insights and examples, we've shown that the rules governing 1031 exchanges are more flexible and nuanced than many investors realize. While this video has provided valuable information, tax planning and 1031 exchanges can be complex topics that require expert guidance. We encourage viewers to consult with qualified tax professionals and real estate advisors when considering a 1031 exchange or any tax-related decisions. Seeking professional advice can help ensure compliance with IRS regulations and optimize tax-saving opportunities. Thank you for watching, and remember to stay informed and empowered in your real estate investment journey. See you in the next video.